Next up, Probity Capital Corporation, co-owner and founder we have with us today is Peter Christiansen. And I've looked at a lot of flow through over the years, and I think the timing with the market just starting to do what it's doing right here, there's a lot of uses for flow through, but one is just to gain exposure to a great looking junior resource market. And Peter's going to quickly go over the benefits of everything, and then we're going to do a quick Q&A. So please do put up your questions, and for either Brian or Peter, and we'll get to those at the end. So thank you, and go ahead, Pete.
Great. Thank you very much, Derek, and thank you to Take Stock for giving me the opportunity to speak to you today. I'm going to talk to you about Probity Capital Corporation. I'll give you a little overview of flow-through shares and flow-through limited partnerships. Then I'm going to touch on the key differentiators between us and our competitors. And if we have some time after that, we may run through a 10K example, but I'm not sure if we will. So let's see how far we get. There's our disclaimer. We can go through that later if you'd like. So who are we? Probity's been around since 2014. We launched our first limited partnership in 2016. We are planning on launching our next limited partnership in the near future, which will be our 10th flow-through limited partnership. In my former life, I was Executive Vice President, National Sales for a group called Mineral Fields and Pathway Asset Management. While I was there over an 8-year period, I had a team of 5, and we raised just over $1 billion within an 8-year period. My business partner is Brent Larkin. You may recognize that name. He comes from the investment banking side. He was over at HSBC, where for a little while he ran equity capital markets, he ran derivatives, he ran syndication and closed-end structured products. And for those of you who are not aware, closed-end structured products encompass all of the flow-through limited partnerships under the prospectus format. He was then headhunted over to Macquarie, where he's one of 6 guys that ran Macquarie Canada. While he was there, he ran syndication, closed-end structured products, and public-private venture capital. Then RGMP bought out the wealth division at Macquarie, which he was a part of, and he went over to RGMP, where he was involved in investment banking for approximately a year, negotiated a package, and walked away from there and came to me asking me if I wanted to start a flow-through company. He said, I have a unique structure that's different from everything else, and you have a lot of contacts. What do you think? So shortly after that, we started Probity in 2014. Our portfolio manager is a guy by the name of Glenn McNeil. You probably recognize that name. He's been in the industry for over 40 years on the PM side, predominantly in the resource sector. And for just under 10 years, he ran Century's NCE flow-through, which was one of the biggest in the last heyday in the mining sector. So I hate to say it, but between the 3 of us, we've got over 70 years experience when it comes to sales, marketing, banking, and portfolio management in the flow-through space. It's a very interesting slide. I'm not sure if everybody's aware of it, but the marginal tax brackets have gone up significantly over the past 5 years. I'm in Ontario today. You can see that we've gone up 15.34%. The folks in Alberta are up 23%. And you can see in Nova Scotia, they've got the highest top marginal tax bracket at 54%. So I always say there's 2 ways to make money. One is by increasing your assets, and the other one is by keeping more money in your pocket and saving on your tax bill. And that's what we'll talk about today. So just a little overview for a few of you that may not be aware of flow-through. Flow-throughs have been around for a long time. It's the 50s, I believe. I think it's around 1957. The government wanted to encourage people to invest in junior oil and gas and mining, and in order to do so, they offered tax deductions. So in our particular case, it's 100% mining, and you receive 100% CEE deduction, which is called a Canadian Exploration Expense. In addition to that, on the mining side, you receive a 15% federal investment tax credit, and there are also additional provincial tax credits. In BC, there's a 20%. In Quebec, there's 20%. In Ontario, there's 5%, and there's a couple others in some of the other provinces. So there's really only 2 ways that's enshrined in the Income Tax Act so that you can deduct on your taxes. One is RRSPs, which everyone's familiar with, and the other one is flow-through shares and flow-through limited partnerships. So the key difference between the 2 is with an RRSP, you generally put your money in, you'll wait 10, 20, 30 years till you retire, you'll get 100% tax deduction. And then when you take your money out, you're going to pay tax on the full amount that you take out, similar to interest income or earned income at your top marginal tax rate. With flow throughs, and in our case, we endeavor to give the money back within approximately 13 months to 16 months of the final close of raising capital. So you can use that money over and over again, usually every 1.5 to 2 years. In addition, you receive 115% in tax deductions or more. And then when you take the money out, you're paying capital gains as opposed to earned income / interest income. So these are speculative securities. The market caps in our case are generally from 10 million up to 500 million. These companies are spending a lot of money on exploration and they don't have a lot of income. So the government's allowing them to, the government's allowing them to flow through their deductions to you to write off on your taxes. So when we came out with our product, we wanted to make sure that we didn't come out with a Me Too product. We wanted something unique. We like to think it's more of a virtuous circle where everybody wins, starting with the investor, the advisor, the mining company wins in this situation. And if you all win, we will win at Probity as well. So we believe that the current flow-through structure was challenged. We believe that flow-through is asset turn, not asset management. We are not asset managers. This is all we do. I like to think we're tax product specialists. All of our competitors have either ETFs or mutual funds or different types of products. We focus 100% on this. And our portfolio manager, Glenn McNeil, only works on our flow-through. So I kept hearing over and over again, I've been in this industry since 2005, and I kept hearing, you know what, I'll give you my money, but please just get me my tax break and get me my money back to me. Don't hold on to it for 24 months or longer. I mean, why are you investing in this product? Is it for an investment in junior speculative mining stocks or oil and gas? Or is it for the tax deduction? Well, in most cases, it's the tax deduction. So the next two slides are going to show you what our competitors do for the most part, and then what we do a little bit differently. Now, this is a basic walkthrough of the existing flow-through structure and process. I'm going to focus in on a 24-month duration fund. Now, there are other competitors out there that are short duration, I believe as short as 12 months. And I've actually seen competitors out there that have a duration as long as 5 years. So for this case, we're going to focus in on the 24-month duration. Keep in mind they're asset managers. They charge a management fee of 2%. Well, if you have a $20 million fund over 2 years, you're looking at $800,000 in fees, and the government charges approximately 13% in tax on top of that. So you get into fees over $900,000. Well, we don't charge a management fee, okay? So you're better off on day one. They go out, they raise the money, they do it through a prospectus. Most of them only offer A class. However, some have been coming in with F class recently. Now they go to place the money. Now I want to look at it from the point of view of a mining company. Let's take one, let's say Tudor Gold. It's one we've invested in a couple different times. We've done quite well with. Let's say Tudor Gold wants to raise $5 million by issuing flow-through shares. In most cases, these companies will go out and they'll get an agent or a banker. That could be RGMP, Canaccord, or one of the big banks. Those bankers will come in, they will collect agent fees, and they will raise the $5 million for Tudor Gold. Well, in a lot of cases, the first thing they're going to do is they're going to go out to companies like ours because they know we're sitting on the capital and we need to deploy it. So they'll go out to, one of our competitors, Middlefield, and then we've got 9 Point, which the portfolio manager is Sprott, and they'll say, how much of this $5 million do you want? And people put their hands up and they take $1 million or $2 million until the whole $5 million is gone. The problem with this is these are private placements and there's a 4-month hold. Well, guess what happens after 4 months in a lot of cases? A lot of them will hit the sell button because they know the first one out gets the best price. And that drives down the price of Tudor Gold. And if we've got it in our portfolio, it also drives down the unit price. So this is not good for anybody involved. Number one, the mining company stock has been hit. The advisor's not happy because their investor has lost money. The investor's not happy because they've lost money. And the only one that really wins here is the banker that comes in and takes the agent's fees and walks away. Okay. So they've placed the money now and they start selling it 4 months in a day sometimes, and they've got cash in the portfolio. Do they give the cash back? No, they hold on to it until the end of the duration, in this case, 24 months, till they roll it into an open-ended mutual fund. Keep in mind how they get paid. They get paid by a management fee. So they're encouraged to hold on to the money as long as possible to earn a fee. Then for you to get your liquidity, they roll it into an open-ended mutual fund. Well, there's actually no need for an open-ended mutual fund. People don't realize this. That's simply an asset gathering tool where once it rolls in, they hope that you forget about it and they continue to earn a 2% management fee. Now, if you're on the ball, you're probably going to get out of that fund on day one. Okay. Well, you and everybody else that's on the ball. And then in a lot of cases, you find that you drive down the price of the mutual fund as you try to liquidate and get your liquidity from the mutual fund. So that was one of the biggest things at Mineral Fields. I kept seeing that over and over again. The fund would be launched at $10. Then all of a sudden, we'd hear that you were getting $8 back, which is pretty good when you count the tax deductions. But by the time you got it out of the mutual fund, it was $7. And the investor was saying, well, what happened? Well, it got driven down as you all tried to liquidate at the same time. So is this really what an investor needs in a tax product? Can you improve the overall outcome for the investor, advisor, and mining issuers? And can you do this more efficiently and cheaper? Well, that's what I'm going to talk to you about next. So here's what we've done. As I mentioned, no management fee. You're better off by about $800,000 or more, including tax on day one. Okay. We raise the money. We do it through a prospectus like our competitors. We offer a BC only fund. I'm not aware of anybody else that does that. We have a Quebec fund. Some of our competitors have those. And we have national class. We offer both A and F units. And then we raise the money. Say it's 20, 40 million, whatever it is. We go to place that money. Okay, here's where we're unique in certain circumstances. Whenever possible, we want to go directly to the mining company. And here's where the mining company actually wins. Whenever possible, we want to take all of the flow through shares. So at 4 months in a day, we don't have to compete against our competitors and drive the price down. So now the mining company doesn't have their stock hit. The other thing too is when we do a deal with the mining company, our due diligence fees are approximately $7,500, of which $4,500 goes to background checks. The next time we do a deal with the same company, if it's within 24 months and nothing has changed with the directors or management, it's $2,500. If they deal with a bank or a banker, they're going to be looking at $20,000 plus for fees. So they really like this. And then the final thing is, if we have all the flow through shares, we can work with the mining company to eke that stock out into the market over a certain period of time without impacting the stock price. So that's how the mining company wins here. So 4 months in a day comes along. If we don't have any competitors in on the deal, we start eking the stock out. We now have cash in the portfolio. Well, we don't roll into an open-ended mutual fund. We send the cash back directly to the clients. In the cases of IROC, it goes to their cash account. In the case of exempt market dealers like Derek Wood, you're going to see a check show up at your door if you're an investor. Okay. The other thing too is we don't have to wait the full 24 months or whatever the duration is, because now we've got cash, we can send it back. So we send the money back in 2 tranches. The first tranche is generally done within 9 months of the final close raising capital. And the second tranche is generally done within 13 to 16 months of the final close of raising capital. And that depends on whether you get into the fall or the spring offering. But again, the cash goes directly back. So now you don't have to roll into a mutual fund. You don't have to worry about driving the price down in the mutual fund in order to get your cash back. The other benefit is if you bought these before, you get a T5013. Well, if you roll into a mutual fund, you have to worry about the adjusted cost base calculation. Well, if we send cash back like we do, you don't have to worry about that. All of the information is on the T5013 form. Finally, warrants. When we have warrants inside of the portfolio, which in the past we've added about 40% of the time on the deals. If you have a competitor that rolls into a mutual fund and you get out the first day, if those warrants are not in the money, you don't get any upside because you're out of the mutual fund. With us, because we send the cash back, as soon as we dissolve, I have to go to the RBC cage, pick up all the share certificates, send them back to the mining companies, and I get them re-registered in trust for the limited partners. So in certain circumstances, if the stock goes up significantly and these warrants become in the money after we dissolve the LP, you as an investor may see another check come back. Okay. So you see how it's a bit of a virtuous circle where everybody wins from the investor and also if there's advisors involved, and then you see how the mining company wins. Now, we don't charge a management fee. So how do we get paid? Well, we get paid by that banking fee that gets paid by the mining company. So instead of the banker coming in, raising the capital and walking away, we come in, we take the banking fee through our EMD connection in the process, and we get paid out of that. And that gets paid by the mining company, and it doesn't hit net asset value. So again, it's a win-win. And I know I'm running out of time here, so let me just review the key features, and we'll have to wait until next time to run through a $10,000 example. So the flow-through key features, as I just discussed, national class units generally qualify for up to 115%, Quebec 128, and in BC 126. The structure seeks to better align investors, advisors, and management. It's 100% publicly traded mining companies because we're trying to turn this as quickly as possible. So liquidity is paramount. There's no management fees. And I just discussed there's no rollover mutual fund and the benefits behind that. And our products have been offered by way of a prospectus. And that's probably where we'll end it for today.